Good morning and welcome to the EMV Capital PLC investor presentation. Throughout this recorded presentation, investors will be in listen-only mode. Questions are encouraged and could be submitted at any time via the Q&A tab situated on the right-hand corner of your screen. Simply type in your questions and press send. The company may not be in a position to answer every question it receives during the meeting itself. However, the company can review all questions submitted today and publish responses where it's appropriate to do so. Before we begin, I'd like to submit the following poll. I'd now like to hand you over to Ilyan Ilyev, CEO. Good morning, sir.
Thank you, and good morning to you all. Thank you very much for joining us, and welcome to the presentation for EMV Capital's interim results. I'm Ilyan Ilyev, the CEO of EMV Capital, and I'm joined here by Ed Hooper, who is Executive Director and General Counsel for EMV Capital. For those of you that haven't seen us before, I'll just go through a quick recap of our investment model. And then I'll get into the results of the business and a deep dive into some of our portfolio companies. So just as a reminder, EMV Capital has, at EMV Capital, we have the vision to be a leading venture capital operator in the deep tech and life sciences space. And recently we had a little anniversary starting with the 5. It's been 5 years since the Net Scientific, as the company used to be called, acquired EMV Capital in mid-2020, which is when the new strategy that we have been pursuing was adopted. We've had quite a growth and quite a journey. We started with 12 million AUM and 8 companies in mid-2020, and we are now at over 100 million in assets under management, of which 38 million are direct on the balance sheet, 66 million are third-party funding, and 70 portfolio companies. This is not the end for us, so we're quite ambitious. We are building a sustainable platform, and our next milestone is at 200 million and beyond. And we're also FCA authorized, which enables us to both do corporate finance type of work and fund management across our practice. Now, in terms of our model, and it's something that some of you will remember we implemented when the combination happened back in 2020, was to recognize the volatility of the venture capital world and to focus on generating our own independent fee income. Our focus is to get to break even. We're not there yet, but we've made significant progress. And our fee income sources include recurring fund management fees as of last year, corporate finance fundraising fees, value creation services fees that we charge to selected portfolio companies, in particular those in our venture build practice, and of course, capital realizations through exits and carried interest where we're exiting companies that are backed by third-party investment. Now, in terms of our operating model, we have essentially 2 playbooks. One is we build capital growth for a subset of companies where we take a deep direct stake as well as third-party funding, and where we employ what we call venture building. And this is where we work heavily with these companies, both in terms of helping them solve their corporate finance needs, helping them access investment for growth. But we're also very proactive in the management of those companies, working with the company boards, their co-investors and management, driving change, driving growth in those businesses, and often change can be quite drastic, alongside deploying what we call our value creation services, a multidisciplinary team that can help the companies in a range of areas, ranging from finance, IP, and other areas. And ultimately, we're driving those companies towards exit, partial or full, to realize capital gains for PLC and carried interest from third-party investments. Another playbook we have is growing our fund management practice, and the 2, of course, can work together. And this is where we're looking at growing funds under management from investors. That can be done on a syndicated basis, as well as through our growing fund structure. And the fund structure, we are the manager of Martlet Capital, a Cambridge-focused early-stage fund, as well as a growing EAS Evergreen Fund working with IFAs and wealth managers. And over time, we're looking to grow the number of funds that we're managing, both through organic and inorganic growth. To talk a bit about our portfolio, again, you have seen many of these companies in the past, and I'll do a deep dive later on the ones that we're more deeply involved. But I'll just say here that it's a diverse portfolio across deep tech, life sciences, and sustainability, companies at different stages of their development. One is NASDAQ listed, another one is in Series C, and yet others are at an earlier stage of their development. And post-period, we've had one addition, a company called Destiny Pharma AMR, which was formed from the acquisition of the assets of Destiny Pharma, a name formerly AIM company, which I'll talk about a little bit later. Martlet Capital itself has also a rich portfolio of smaller stakes than what we typically have, but this is where we have actually integrated Martlet Capital fully inside EMV Capital's structure, both on a team level and on an operational basis, but also from an investment perspective, we're now starting to co-invest from our EIS investment practice. So recently we announced an investment in Xampa, roughly $250,000 from EMV Capital's EIS practice, as well as exits. We've had an exit from the Martlet portfolio, locking in a 2.3 times return on a modest sub 1 million exit. Again, showing the model starting to work both in terms of exits, co-investment opportunities, and deal flow for the rest of the business. This was, if you recall, we announced this transaction last year, the taking over of Martlet Capital's fund management, and we're very excited to see it now become a full part of our business. Switching to financial highlights. So group revenue decreased slightly to 1.1 million versus 1.2 million the previous half. But as I go through this, I want to emphasize because of the way we account group revenue, but that also includes certain portfolio subsidiaries, which are actually funded by third parties. So instead of that, we talk about the core operational revenues, core loss, core costs, which is EMV Capital itself, the operation of our corporate finance side, value creation services, and so on. So in terms of at the core level, EMV Capital's revenues have remained the same as last year, and they have covered 79% of our core costs. It's not quite break even, but we're getting quite close to that very important milestone. The loss at the core level for the half year has decreased to 0.3 million from 0.6 the first half of last year, again showing the trend. Our group loss has also decreased to 1.5 million, reflecting cost controls at ProAccess level and lower R&D costs at Glycotest. Now, turning to assets under management, which is a core metric for our business. So our total AUM, direct and indirect, has reached 105 million, and we ended last year at 98.5. Of that, 38.6 million is fair value of direct holdings owned by PLC. 66 million is managed third-party holdings. In the first half of the year, we have syndicated roughly 5 million of investment, slightly less than in the first half of last year. Actually, it's been a very active half in terms of the number of transactions. However, in the context of a difficult fundraising environment, we've helped companies with what often were smaller fundraisers, helping them get to the next stage of their developments. Our total assets have increased slightly to 19.7 million, but net assets have decreased a little bit to 13.6 million, and adjusted net assets are at 29.3 million. I've got a slide later on to try to link the net asset metrics to our share price, which is important from your perspective. We've also made clever use, or we think clever, of our paper. We've made roughly 400,000 pounds worth of investments through the use of EMV Capital shares. This was used primarily to underpin a very important investment round in Qbot, and I'll talk about how that company has evolved. And we've ended the half of the year with £500,000 of cash and a further £1 million of realizable quoted securities. On the cash side, I want to emphasize we are an operating company. We generate cash through ongoing activities. We manage a debtor book, so it's a live picture continuously. In terms of the fair value composition, again, if you looked at this a few years back, it was concentrated in a few positions. Now, as our fair value has grown, it has also diversified. What that means is, first of all, from a risk perspective, we have a broader spread of risk across our portfolio. But from an opportunistic perspective, it also means we have more shots on goal, more opportunities to take deeper stakes and to realize investment returns. And you can see also here on the right-hand side of this graph how the assets have diversified between directly owned funds, managed, and syndicated investments. And we anticipate that picture to continue as we grow all sides of this pie. Now, this is a very important slide. It is around linking our current market cap, our NAV, but also finding ways in which we can better measure the true value of our business. So because of accountancy measures and how subsidiaries are being measured, the NAV of 13 million actually undercounts the true asset value of the business. That's why we've developed the adjusted NAV measure, which also counts the direct fair value of our subsidiaries and a further measure of fair value. So what you can see here is that on the adjusted NAV per share and fair value per share, we'll end up at 106 and 1.39 for these metrics versus the current share price of under 50p, which suggests, in our view, a significant scope for growth to align share price with our underlying value. However, even these measures, we believe, do not capture the full value of the business, partly because these are inherently historical and retrospective. They do not capture the embedded goodwill within the operating businesses, which are shown to consistently generate revenue, the future carried interest from the fund performance, and the expected growth in the underlying portfolio. This is a growing portfolio. It's not going to stay this way. These companies are growing in value and in performance. As a result, we as management and as also shareholders feel that the current market cap significantly underestimates the group's real value. What are we going to do about it? Well, what we're doing, we're going to consistently provide proof points of our business model working and look to implement what we promised. Now, I'm going to talk a little bit about our venture build portfolio. And, we gave it a name, but we've been doing it for a while. And essentially what we do here is we're targeting IP-rich companies in our markets of focus, life sciences, sustainability, deep tech, companies that have had significant investment into them in the past, but they need strategic direction. It could be that they're in the middle of a pivot because the market has changed. It could be that they need to try something else. There's different cases. But in all of these situations, we are able to take deep direct stake through the combination of our corporate finance practice, our investment capabilities, and our ability to take companies forward on growth post-investment. And we take those direct stakes, sometimes with a little bit of cash, but typically through in-kind services. Sometimes we deploy EMV capital paper as appropriate. Post-investment, we support those companies through our value creation services practice to help the companies get to the next stage, to become autonomous once again, and we bring third-party investment to those. Doing this for the last few years means that we have created 9.3 million of fair value from 400,000 pounds of cash investment and 500,000 of in-kind services. We believe this is really an extraordinary performance across these portfolio companies. It's half the story. Ultimately, it's about getting these companies at exit, but we've had some good stories here with Deep Tech Recycling, a company in the chemical recycling space, where we've had a fair value increase of 2.5 million. Dename it in the lab quality control space, Ventive in heat pumps, Vortex in liquid biopsy, and Wonder Health in digital health monitoring. All of those companies, we have significant double-digit direct stakes in these companies, and we've seen significant direct fair value increase. And it's not static. We're able to add companies to this to our venture build program. And here I'll spend just a little bit of time talking about the acquisition or the addition of Destiny Pharma AMR Limited post balance sheet, post period. So Destiny Pharma is a name that many of you are familiar with. It was an AIM-listed company until last year. Very promising company in the antimicrobial resistance, antibiotic resistance space. It is a huge space, very, very, very important for global healthcare and a potential global health crisis on our hand. Surgical site infections alone are responsible for 1.6 million deaths globally. In the US, we believe there's up to 2 million surgery patients that could benefit from this technology. But what did we do? Well, we have been tracking this asset for quite some time. We took our time to understand it. And then over the summer, which seems to be a period, summer and Christmas is our favorite period for deal making, we moved forward towards closing a deal. The company had previously completed a phase 2B trial for nasal gel with promising returns, but ran out of steam, ran out of cash when it came to launching a phase 3 trial. So what we did is we set up a new company through which we bid for the XF73 family of assets from the administrator. And in a very short period, we syndicated roughly 1.3 million of investment from our investment network to fund the acquisition and the post-acquisition venture build program. From our fee generation perspective, we generated some corporate finance fees. We have a 2-year value creation services contract. But importantly, post-closing, on a fully diluted basis, we have 30% holding in this business, and we've added £500,000 of direct fair value to PLC at nil cash cost. So again, this is the result of several years of development of our practice that has now come together. That means we are able to do these deals over and over again as a playbook of building capital value in our areas of focus. Now, what are we going to do post-acquisition? Well, the phase 2 has been completed before us. We're now putting together the management team that will take the business on a go-forward basis. And we're looking to restarting or finding the route to restarting the phase 3 trial preparations and eventually launching a phase 3 trial. Now, some of you will say, well, hold on, that's pretty expensive, launching a phase 3. How are you going to do it on a capital efficient basis? And again, here I want to direct you to what we have done with Deep Tech Recycling, a plastic waste recycling company, not much to do with antibiotic resistance. But there again, we had a the challenge of building a capital efficient approach in what's fundamentally a capital intensive industry. And what we have done there is build JVs with partners and set up an SPV to fund the investment on a separate side, minimizing the dilution at the top core level. So we have some ideas of how we can do this on a go-forward basis. It will take a while. It takes a while to get the FDA comfortable with preparation for a phase 3 trial. But we believe this new program brings even more potential for outsized returns for EMV Capital shareholders in the years to come. I'm going to go through some of the other portfolio companies that we have tracked with you over the last few years. Sofant has continued to grow. If you recall, this is a next generation phased array SATCOMS antenna. Space technology, space development, space industry, telecoms from space is even more in the headlines now. When we originally backed the company a few years ago, it was not. It was science fiction. It has worked out well. But the company now is in a race to launch their commercial sales. We anticipate the launch of commercial sales in the first half of 2026. They've tested their antenna successfully on customer networks in the UK and Italy, and they're integrating their technology into satellite terminals, as we speak, into the end of the year. We've seen growing interest from OEMs as people realize the technology Sofant has is exactly in the right space. We believe the launch of commercial sales by Sofant will be a major value inflection point, and it will clarify routes to exit for the business. Wonder Health is a digital health monitoring company that has been part of our venture build program for a while. We have a 14% direct stake in this business. And again, by iterating their model on a capital efficient basis, eventually they found the right market fit for them, which, as it happens, is with healthcare providers and pharmacy benefit managers in the US. They've been accelerating their ARR. They're on track to get to 1 million ARR within, I would say, in early 26. And that, again, is a major value inflection point for that company, both in terms of opening up broader sources of finance, but also the proof of the model to get them to scale up. We see this as another excellent development in our portfolio. Deep Tech Recycling, that I mentioned earlier, have also made progress on several pilot projects. In particular, they've received an indicative term sheet for debt financing from the Norwegian government for roughly 11 million. A plant costs roughly 20 million. That is done in a non-dilutive way to Deep Tech Recycling itself. It's done through an SPV formed with our Norwegian partners. But in addition to that, there is another 2 or 3 additional projects under discussion, again, making sure that there is a portfolio of approaches as the company moves to the next stage. We have 17.5% of this business, and we believe there is enormous value upside left if the company manages to launch a commercial project. Continuing on, Proaxis, which is a subsidiary of EMV Capital, they develop and supply assays for pharmaceutical research to clinical trials. They had a very good and strong 2024. Unfortunately, in early 25, due to a quality issue with one of the suppliers, they had to pause production. And that took until September to resolve. Production has restarted, and there is an order book that is being resolved, but this has led to significant slowdown in revenues for this year. Nevertheless, the company has made progress on a go-forward basis with a much stronger supply chain, but in other aspects of the business. We have now launched a COPD clinical study with Imperial College London, which, if successful, we believe will multiply the market for ProAccess in terms of their usability in clinical trials. And they have also moved to the excellent Randox laboratories outside of Belfast and looking to develop relationships with Randox, a giant in the diagnostic space, as the company goes forward. Glycotest has continued its progress with its assay development. However, they're cash constrained. So there is an ongoing fundraising round for the business. It needs to close that investment to continue to make progress in its program. As you know, in the US, the fundraising environment for biotech is very, very tough. Nevertheless, the company is making good progress in investor discussions. Finally, on the portfolio, I'll talk about Qbot. It's one of our long-term portfolio companies, a really excellent robotics and AI platform for in the construction industry for automating retrofit. The company underwent through a very difficult transition last year, where they had to restructure their model, cutting down OPEX by about 70%, drastic reduction in team size. And EMV Capital played a key role in the rescue of that business, securing rescue finance while protecting our own position in the business. That transition has been executed, and we've been able to attract a strong CEO to the business on a go-forward basis, again, focused on growth in what they're really good at, which is underfloor insulation, but also driving increased profitability, increased revenues for that business. The valuation has decreased significantly, but we believe from this lower, more lean basis, we're able to grow. Importantly, for EMV Capital, we have protected and, in fact, increased our stake in the business, holding close to 30% of direct and 54% advised for that company. If the company is able to reach break-even, the bets are off. It's a really important space in terms of applying robotics and AI in the construction services industry, which, as you know, both in the US and the UK is labor constrained. So they're in the right space. They got to get the proof points. So I think that gives you a look-see under the hood what we've been up to. In terms of on a go-forward basis, look, we believe that even without raising a new fund, our AUM will continue to grow simply because the portfolio is growing and we are going deeper in some of these companies. However, we are looking at continuing to build the fund practice, both organically and inorganically. The EIS practice is also growing. One benefit of the increasingly complex UK income tax environment is that EIS is becoming an increasingly important tool in tax planning, and we're benefiting from that. On the revenue side, we're continuing to grow to get to break even at core group level. I don't want to give you a specific forecast, but you see the trend is really going in the right direction. Market environment, okay, it's tough, difficult. We all know that. We read the doom and gloom in the headlines. You know what? From our perspective, in any market environment, there are opportunities. At the moment, in the current environment, there are such excellent opportunities such as Destiny Pharma that we're able to capture. When the market environment improves, there'll be other opportunities, but we are focused on building up the exit opportunities within our portfolio. As we expect the market starts to improve, we'll be able to start realizing exits. We are really well positioned for a market recovery. We have seen that the deep tech and life sciences space specifically has not been affected as much as other sectors. And overall, it looks like both government and the financial system see the space we are in as really important, and we're well positioned to grow from that. So in sum, we're well positioned to capitalize on the growing venture capital landscape and the evolving UK economy, both through capital gains potential. There's the potential upside from carried interest as we grow our fund practice, path to break even at EMV Capital level, which would make us autonomous financially. And we now have a proven value creation model over and over again where we can create enormous capital value with minimal upfront cash and a diverse portfolio through which we can run our strategy. And with that, I'll stop.
Ilya and Ed, thank you very much for your presentation. Ladies and gentlemen, please do continue to submit your questions just by using the Q&A tab situated on the right-hand corner of your screen. Just while the company take a few moments to review those questions today, I'd like to remind you that a recording of this presentation, along with a copy of the slides and the published Q&A, can be accessed via your Investor Dashboard. As you can see, we have received a number of questions throughout today's presentation. Can I please ask you to read out the questions and give responses where appropriate to do so, and I'll pick up from you at the end.
Thank you. So starting from the top, there's a question around, are there any near-term exit opportunities you're working towards? And I would say that the answer is yes, but nothing is for sure. Compared to a year and a half ago, we are even more focused on mapping out the potential exit routes of the companies that we have. But equally, we want to exit in the right way. I've talked about the recent exit we had from Matlet, which was something that we actively targeted. It wasn't given to us; we asked for it. So we are showing that on a proactive basis, we're able to generate these opportunities. But in terms of where the large upside is going to come from, that is going to be from most likely from trade sales, IPOs. That sort of approach. We, by being actively in the market, I would say we are in a good position to identify such opportunities and to help our companies to structure those opportunities. But again, these sorts of things will take time. Okay. There is a question on how robust are your valuation methodologies in the current venture capital environment? Again, excellent question. We follow the BVCA methodology, and at EMV Capital PLC level, that also goes through an audit with our auditors. So it's been stress tested significantly. I think on a risk basis, we also take provisions when we see that something, we have question marks over something, even if formally the valuation hasn't fallen. So we feel it's, as strong as it can be within the VC industry. Of course, there's always an element of subjectivity in these things, but we're following the methodology quite consistently, and it makes no sense for us not to do so, because if we go up one quarter, next quarter goes down, that doesn't help anybody. We're in this for the long run. Ed, do you want to add something on the valuation framework as a whole?
I think probably just, thanks, Elaine, probably just reinforcing what you'd mentioned a little earlier on, which is the BVCA guidelines are what we use for the valuation, and as you say, they're subject to annual audit. But as you mentioned, they miss out a lot of the potential upside that I think we see, which is just not built into the valuation. So we think that there's a delta there. As the examples you gave, they're all good ones. It doesn't capture goodwill of our operating businesses, the likes of EMV Capital Partners, etc. It doesn't incorporate future carried interest payments, which is one of the key reasons that we're doing all of these investments with our various investor syndicates and funds. And it also doesn't capture the moment between the last fundraising price, which could be up to a year plus in some cases ago, and all the good value inflection points that the companies have reached along the way since that time. So I think there's a lot of upside that we see as a management team in the valuations, which is just not built into the more formal metrics that we need to use as part of the BVCA guidelines.
Thank you, Ed. And it was the next question. When can shareholders expect an exit from one of your portfolio companies? And what will we do with any excess cash? Will it be returned as a dividend or a buyback? So as I flagged earlier, we are starting to see small exit from the broader portfolio, which trigger carried interest or might trigger a capital return. In terms of the larger potential exits, of course, those are longer term and take time to build out. So, there's nothing specific that's about to happen. But on the question of distributions, again, maybe I'll ask my colleague Ed to talk through, because also he has a good sense of how others do it in this space. Ed?
Yeah, thanks, Celine. So yeah, I think you're right. We've seen some good examples of secondary trades, both historically, as we've previously reported, and more recently with Sampler for Martlet Capital. We're expecting those secondary trades to continue in the absence of any sort of fuller form M&A exits, or for that matter, IPO exits. The markets are difficult for finding an exit in this environment, and we're fortunate, or we consider ourselves fortunate, that we don't have to rush to make a call on exiting at potentially the wrong time and the wrong price, of course. And I suppose that leads us on really to then sort of the point that we're an evergreen structure, so that gives us the benefit of time. We don't want to wait around deliberately and hold on to assets. We want to see them go and fly from the portfolio, but to do so at the right time and the right valuation. So assuming there is excess cash, that's all for review. But clearly, if there's excess cash, the board can meet and structure the company in such a way as to be able to return the cash. We should also remember that the evergreen structure is there to provide shareholders with exposure to future investments, though, and we're not in a sort of wind down mode where we're just looking to sell the portfolio interests that we currently have. We're looking to expand and put into the existing portfolio further follow-on capital where it's required in order to grow those investments and the value there. And we're also, as we've demonstrated with the likes of Destiny Pharma and others in the venture building portfolio, looking to increase the group's exposure to new companies and new investments. So I would anticipate a mixture of both in an exit scenario.
Thank you, Ed. And the next question is, do you anticipate expanding co-investment opportunities with Martlet Capital beyond Sampler? So, I mean, when we took over the fund management of Martlet Capital, we told the market why we did that. And certainly one aspect was getting access to more fees and more recurring revenues and growing the AUM. But strategically, it was really important for us to build depth in the Cambridge cluster, not only because it's the Cambridge cluster, but if you've got depth in Cambridge, that gives you access to deal flow across the country. But in addition to that, given the nature of Martlet Capital is a really broad portfolio of 50 positions, of some of them, probably nothing to write home about, but a number of them really exciting, it gives us access to extended due diligence over many years, understanding those companies' relationships with those management teams and the co-investors. And as a result, we're able to identify interesting opportunities that fit with our investment thesis fairly early on. So absolutely, we're looking to do more. And that's good both for the companies that we're backing, it's good for the Martlet Capital practice, and it's good for our EAS investment practice. I'll say one more thing. Architecturally, if you will, the way we want to build our EAS investment practice, both the syndicated deals and the EAS fund, is in a way that makes it attractive to the IFAs and the wealth managers as a genuinely unique combination of both access to the super returns from our venture build practice and the later stage de-risked investment opportunities such as Sampler, where investors get exposure alongside other large investors. So we think this combination is quite unique on the EAS market right now, and we have various initiatives through our EAS investment practice to capitalize on that. And a final question that I see here from George: which companies in your portfolios are you most excited about? And I mean, I hope what comes through is that it's not the one or the other. We're genuinely excited across the portfolio of the companies that we have. And if I can, I suppose, call out a difference, our model is somewhat different from the classic textbook VC model, which is invest in 20, one returns the fund, one pays for the carry. Our approach is different from that. The companies we engaged with, we believe every one of them can be successful, and we almost bring a owner approach to it. We might not own them directly, but we feel ownership of the results and help those companies get to the next stage. They might not be unicorns, but from a return to investors perspective, the returns we believe are probably higher than if you had a tiny little bit of a unicorn somewhere down the pref stack. So from that perspective, the businesses that you see us talking about, we are excited about all of them, and we are at different points of their life cycle. We're perhaps more worried about one than another, because they all go through troubles, and we, just like with Qbot, we roll up our sleeves and kept them to get out on the other side. But each and every one of them has outsized potential, both as a business, impact on industry, and investment returns for EMV Capital shareholders.
Ilya and Ed, thank you for answering all those questions you can from investors. And of course, the company can review all questions submitted today and will publish those responses on the Investor Meet Company platform. Just before redirecting investors to provide you with their feedback, which I know is particularly important to the company, Ilya, could I please just ask you for a few closing comments?
Look, I'll say something I've said in previous IMCs. Yes, we're in a tough investment environment, but in a sense, so what? There are opportunities in every investment environment. We're a specialist that has proven through multiple projects that we know what we're doing. We can identify the special opportunities, turn them around, get them to the next level, and we can drive value. So in terms of on a go-forward basis, we will not be in a AIM winter and a VC winter forever. We are starting to see some green shoots. And we think that our model now is stronger over the last few years in terms of being closer to break even, but also with multiple shots on goal in terms of outsized capital gains potential across not one, but many opportunities. Adding to that, the carried interest upside from our growing fund practice, and also the future scalability of a proven value creation model. Both myself and Ed and the rest of our team are committed to this business for many years to come. This is a platform we want to grow into a major UK and European player, and we feel we have found the right formula. So there's a short-term, medium-term, and long-term benefit to sticking with us. And I hope you make good investment returns out of it.
Ilya and Ed, thank you for updating investors today. Can I please ask investors not to close the session, as you'll now be automatically redirected to provide your feedback in order that the management team can better understand your views and expectations. This will only take a few moments to complete, and I'm sure will be greatly valued by the company. On behalf of the management team of EMV Capital PLC, we'd like to thank you for attending today's presentation, and good morning to you all.